If we look firstly at the country, what's happening in the country, we see that there is, again, on a national perspective, CoreLogic have produced a statistical data point called the Daily Index. They've stopped running that for and is distributing that for the broader public for the time being, while there is a significant shift in activity. But you can, and we've been playing with this data, we're able to extrapolate out where the market has been going. And if you have a look relative to daily transactions, daily activity, and daily movement, we can see that the national market broadly, from the peak back in October 2017, and again, this is a national representation of daily activity in the property market, we can see that there was declines. It declined further leading into this point down here around the 18th of May in 2019, which was in fact the day of the election. It plateaued at the bottom for a period of time. It took off after the second interest rate cut and lifted until such time as mid-March, when the phase 2 restrictions came in place and people thought, oh, this is real. Let's just pull our heads in for a while. It plateaued. And then from around about end of March, we have seen a decline in price across the country. Now, the decline in price has been nominal. It is not significant. And it has taken a long time to see impact even on a daily basis. And people could, I mean, at this point with this small amount of data, people could go, this is the beginning of a massive trend. And frankly, we don't see that. Oh, don't know what happened there. Oh, wrong button. Hang on a sec. Catching up. There we go. We don't see that. What we see now, CoreLogic have also produced a leading indicator release of data. They've called this the pre-listings activity. And the pre-listings activity is the what search activity is occurring and what comparative analysis is being done before listing a property to get an assessment of what the value of my property might be. And if you measure that, then there's an indication of what's happening in the market. And what we're seeing is, if we compare year on year, where is my mouse? Here it goes, my mouse is over there. So there it is. We can see that, again, grey being 2019, leading into, and this is where the election occurred, into the listing activity. There was a gentle decline. This is Easter Sunday, not a lot of search activity on Easter Sunday. There was a gentle decline leading into the election, and in 2019, as we go forward, you'd expect to see some rate of incline in the listing, pre-listing activity going forward. However, what we've seen as a result of the first, or rather phase 2 announcements of restrictions, phase 3 announcements of restrictions, we've bottomed out in April, and pre-listing activity, excluding Easter, has actually started to climb and plateau and be somewhere near where it was post-election back in 2019. So we are in a similar position of, I guess, mental perspective as a country around where we're at with our listings activity, which is quite positive for the supply of stock onto the market for selection. Back here, we had some significant issues. There was demand which held price, demand exceeding supply. The number of properties on the market was low. The number of people needing to buy was higher, and that supported a static price position. We are seeing an increase in listings, but we're also seeing, as a result of the ability for people to get back into the market and the release of our ability to do open for inspections and attend auctions, we're seeing a lift in both sales and listings, which is quite encouraging from the perspective of stability of price going forward. If we have a look at the mortgage activity, now Simon went through in great detail around what's happening in finance. And the investigations show there are a number of influences on demand, but the greatest influence on demand and the ability to buy is finance. If we want to cripple the Australian economy in housing, then restrict finance, as we saw when APRA and the banks restricted finance back in 2018, leading into 2019. It caused a decline in market value. But we're not seeing that now. In fact, we are seeing a dropping of restriction and an ability, or falling in increase, for want of a better word, falling in restriction, increase in ability to borrow money, and an encouragement from us to do so. So on that basis, then we are likely to see an increase in the interest and the ability to buy, which then supports an increase in demand. Available funding is one of the key primary things to be met in order to achieve our ability to increase demand. And so what we're seeing in mortgage activity is a plateauing or flattening off, which is powerful from a sustainability in price. Now, as we talked about earlier around property predictions and its ability to be able to identify what's happening in a city at any one time and then forecast movement going forward. In the analysis that I've done on the data that has been available and the interpretation of the output of that data and those algorithms, we can see that the current market is in a state of decline. Now, you've got to remember, as much as this is a significant chunk of the number of suburbs in the country, and that there is decline, the level of decline here is single-digit decline. If all of this pie chart was grey, the entire country would be going down by 4-5% maybe. And at the moment, we're seeing a slow rate of decline, offset by some growth in the country across selected suburbs. Point of interest is the change in the market and to where it's headed. Having a look at the data going forward in 6 to 12 months, we're actually anticipating this sort of data outcome, this sort of market position on a suburb level. We are seeing a massive drop in the number of suburbs in single-digit decline, and a massive increase in the number of suburbs moving into single-digit growth, as well as a significant lift in the number of suburbs into double-digit growth. We will see a balancing of the market, mixed market, but an overall balancing of the market going forward. To the extent that in 12 to 24 months from now, we will see growth. We will see a significant number of suburbs in double digit, a massive number of suburbs in single digit growth, offset by a smaller number of suburbs in single digit decline and double digit decline. The net effect is probably a rate of growth in net single digits, 5%-ish, 12 to 24 months from now. And that is incredibly encouraging as a forecasting mechanism, or as a forecast for what's happening in this country. Obviously, things could change if we had a second wave, and if the protests that are occurring this weekend cause an increase, a spike, and an uncontained spike in coronavirus events, then we will have an impact on the economy again, as if a second wave occurs. The odds against that are quite high, and particularly if people have participated in the registration of the app, and we're able to then contain those spikes and the people in contact. If we're able to contain that, then great, we won't get a full-on second wave, and this sort of forecast can hold true. If we do get a second wave of pandemic, then it threatens the forecast here. But all things being equal relative to the health of the nation, I find this incredibly encouraging going forward, particularly with the statistics of the preemptive data that CoreLogic have come up with, saying that mortgage activity is flat and listing activity is strong. So on the basis of that, then, if we forecast, we are actually anticipating this sort of behaviour where the current market sits here and is in a slight decline. We will then see the market bottoming out in 6 to 12 months with a 12 to 24 month rate of growth. Now, if we extrapolate that out into each of the states and the major cities, in Sydney, we're seeing this on a daily basis. where it reflects quite similarly to the national market. We can see the current market in Sydney not as dramatic in the amount of, in the volume of buyer suburbs. We are seeing a decline though in Sydney as reflected in the graph here, not again as dramatic as it is in the national market. But we are seeing a significant rate of growth in Sydney in 12 to 24 months. In Melbourne, we have seen a far greater decline of suburbs. And if you have a look in Melbourne, we are seeing a significant smaller amount of suburbs in double-digit growth, offset by a larger number of double-digit decline suburbs and quite a significant amount of buyer suburbs. That will almost flip entirely in about 12 to 24 months' time, where you'll see a massive growth in the double digits and into the seller markets, which is, again, really quite exciting for a forecast for Melbourne as a CBD's, Victoria as a state. If we look at Brisbane, Brisbane has fared quite well and has only recently started to plateau out. If we see that, then there is a far smaller number of single-digit decline suburbs. We can see that Brisbane is moving into a significant rate of single-digit growth, seller market suburbs going forward. So 12 to 24 months from now, we're looking to see a lift in prices in Brisbane. If we have a look at Adelaide, Adelaide is contrary to the rest of the country in that Adelaide is already in growth. Adelaide has not seen a decline on the back of the consequences of the pandemic since even October 2019. Sure, it dropped after the initial conversation around restrictions, but that reverted very rapidly into a more reliable and sustainable period of growth. So Adelaide's serving itself really quite well right now in property price value inclines. If we have a look at the market broadly, it's reflected in the amount of suburbs that are currently in growth relative to those in decline. It is a solid market to be playing in if that's the area you're in right now. Of course, again, suburb selection is critical. There are suburbs in Adelaide which are in decline and double-digit decline, but there are significantly more in double-digit growth. Where it's headed, though, is what's important. And where it's headed right now is we are moving into a far greater rate of growth for Adelaide going forward in the next 12 to 24 months. Again, very exciting for those people who live in Adelaide or those who are looking to invest in Adelaide. If we look at Perth again, Perth had done it hard for a period of time leading into November last year, started a gentle wave out, but has been hit by the pandemic. It wasn't an immediate reaction and only recently has it started to come off. If we have a look at Perth, there is a lot of single-digit decline, but they are low decline numbers, 1% and 2% in decline, 3% in decline. The net effect or net balance in Perth is actually a low 1 or 2% aggregated decline right now. What we're going to see in Perth and what we're looking forward to in Perth is a virtual flip of that into a position of growth again in the 12 to 24 months as we all recover from the pandemic scenarios. So that's where we're at right now with respect to the broader property market. It's really quite exciting to see where the market is headed. And again, it's contrary to a lot of the media grab and the media spike of doom and gloom and definitely the Harry Dents of the world.